stagflation. Now, the working model is if unemployment's low and growth is strong, then that's inflationary. If unemployment is high and growth is weak, then that's disinflationary or deflationary. So it's like a seesaw. One's up, the other one's down. That's the standard model. There is no empirical evidence to support that model. The fact is there's no correlation between growth and unemployment on the one hand, so-called Phillips curve, and inflation on the other. You can have high inflation and high unemployment, which is what we had in the late 1970s. You can have low inflation and high unemployment, which we had in the 1930s. You can have low inflation and low unemployment, which we had in the 2010s. In other words, there's no correlation. So while the Fed keeps saying we have to tighten to fight inflation, I'm saying there's no correlation between the two. They are tightening, but inflation will come down, eventually come down on its own. But in the short run, it's going up for supply chain reasons. Reduced oil output. Biden's draining the strategic petroleum reserves and the New England gas and diesel reserves, et cetera. So we could be looking, I think we are looking at a situation right now based on the data where growth is slowing and inflation is going up, but the central banks that's not how they think about the world. So, and there's a name for that. It's called stagflation.
In a recent eye-opening interview, renowned economic analyst Jim Rickards delivered a sobering message. The global economy wobbles on the brink of a devastating depression. Drawing attention to a confluence of alarming factors, including the specter of stagflation, the rapid erosion of United States treasuries, and the emergence of a new currency among BRICS nations poised to challenge the dominance of the dollar, Rickards paints a grim picture of impending financial turmoil. However, amidst this dire forecast, Rickards offers a glimmer of hope. He identifies a single asset that he believes has not only the ability to protect you from the worst effects of this economic downturn, but potentially turn you into a millionaire. So in this video, we are going to dive deeper into Rickards' dire warning and also explore the fascinating insight that he shares regarding this one asset that could be your lifeline in turbulent times. Picture this: the 1930s meeting the 1970s. Bizarre times indeed. According to Jim Rickards, we are living in a sea of anomalies. And one major anomaly is the rising price of oil. But why is this happening? And what does it mean for us? Let's explore more into Rickards' insights to understand the gravity of the situation. Rickards explains that central bankers, particularly in the West, are out of touch with real economic conditions. While traditional models suggest a correlation between unemployment, growth, and inflation, Rickards argues that there is no empirical evidence supporting this. In fact, history has shown that you can have high inflation and high unemployment, low inflation and high unemployment, and so on. The current tightening measures by the Federal Reserve might not be as effective as they hope. Now, what exactly is stagflation? Imagine a scenario where economic growth slows down while inflation rises. A nightmare for any economy. This toxic combination creates a situation where the cost of living increases, but wages and employment opportunities don't keep pace. Well, according to Jim Rickards, this is the reality that we're facing right now. Historically, stagflation is most associated with the 1970s in the United States. During that decade, the economy experienced sluggish growth, rising unemployment, and high inflation rates. The inflation rate peaked at around 13.5% in 1980, while unemployment rates reached a high of 9% in 1975. This period of economic distress was triggered by several factors, including oil shocks, where oil prices skyrocketed due to geopolitical tensions and supply disruptions, leading to increased production costs and consumer prices across the board. Fast forward to today, similar supply-side issues are driving inflation up. For instance, global supply chain disruptions caused by the COVID-19 pandemic have resulted in shortages of essential goods, pushing prices higher. Additionally, reduced oil output due to geopolitical conflicts and policy decisions has contributed to rising energy costs. The U.S. government's decision to drain the Strategic Petroleum Reserve, aimed at stabilizing fuel prices, has provided only temporary relief, leaving long-term supply concerns unaddressed. Central banks, particularly the Federal Reserve, are primarily focused on controlling inflation through monetary policy tools like interest rate hikes. However, these measures mainly target demand-side factors and do not adequately address the supply-side issues causing the current inflationary pressures. Rickards warns that if central banks continue to overlook these supply-side problems, we could be in for a prolonged period of economic stagnation combined with high inflation, the dreaded stagflation. And as if things couldn't get any more complicated, the BRICS nations are stepping up their game. The BRICS, comprising Brazil, Russia, India, China, and South Africa, have expanded to include new members, now representing over 50% of the world's population and approximately 55% of global GDP when measured by purchasing power parity. This shift marks a significant transformation from their earlier status as a group of developing nations to becoming formidable economic powerhouses on the global stage. Jim Rickards emphasizes that while individual currencies like the Russian ruble or Chinese yuan are unlikely to achieve global reserve status due to various limitations, the BRICS nations collectively have the potential to issue a new currency.
If you're asking, will the Russian ruble be a global reserve currency? No. Will the Chinese yuan be a global reserve currency? No. I could give you 100 reasons why, but they don't have bond markets, they don't have good rule of law, they don't have repo, primary dealers, et cetera. They don't have all the things you need to, in terms of having a securities market, to be a global reserve currency. So you can forget about that. But could they collectively issue a new currency? Call it a BRIC, call it whatever you want. They call it a Bancor, that they would all accept and trade between each other, and that actually third parties would be welcome to join, with an issuing bank and a clearing mechanism and evaluation mechanism. Yes, that would not be that difficult to do. In fact, they're already working on it. So why haven't they done it yet? What's the missing ingredient? Well, here's the missing ingredient.
This new BRICS currency could challenge the dominance of the US dollar in international trade. Currently, the dollar's hegemony is largely uncontested, but a BRICS currency used for trade among these major economies could significantly disrupt the status quo. Jim Rickards also highlights his concerns about the potential collapse of the U.S. Treasury market. But how?
The effort to steal Russian assets. Now, at the outbreak of the Russian special military operation in Ukraine, at the start of that, the U.S. froze the assets of the Central Bank of Russia. Yes. Almost unprecedented, not completely, but almost. About $300 billion of U.S. Treasury securities owned by Russia. That they had surpluses, they had dollars, they invested the dollars in U.S. Treasuries. They had about $300 billion. They're all digital book entry. There are no physical Treasury securities you can put in a vault. Haven't been since 1979. So this is a digital ledger maintained by the Fed and the Federal Reserve and the U.S. Treasury. And Russia had about $300 billion of Treasury securities. So we froze them. Freezing them just means, okay, they're still Russia's securities, but they can't use them. They can't collect the interest. They can't pledge them. They can't repo them. They can't sell them, etc. They're kind of frozen, but they still belong to Russia. Now the U.S. wants to go a step further and seize them, actually convert the title, turn it over to some trust fund for the benefit of Ukraine. And actually, they say seize, I say steal. So they want to steal the Russian assets, the $300 billion.
Jim thinks that if the U.S. and its allies proceed with plans to seize Russian assets in response to geopolitical tensions, Russian President Vladimir Putin is likely to retaliate by expropriating Western assets in Russia. This could include major investments from companies such as BP, Chevron, and McDonald's, which have significant operations and assets within Russia. The expropriation of these assets could lead to substantial financial losses for these corporations and destabilize investor confidence in multinational investments. However, the real danger, Jim Rickards thinks, lies in the global clearance and settlement system. Over $200 billion of Russian assets are held in Euroclear, the largest clearing, settlement, and custody organization in Europe. Euroclear manages over $40 trillion in total assets, including stocks, bonds, and other securities. If the U.S. and its allies decide to seize these Russian assets, Russia could respond by suing Euroclear in various international jurisdictions where Euroclear operates, such as Hong Kong, Singapore, and Bahrain. For instance, if Russian lawyers were to file a lawsuit in Hong Kong, a jurisdiction with a legal system that, while under the influence of China, still operates with a degree of independence akin to Western legal standards, they could potentially secure a judgment in favor of Russia. This judgment could allow Russia to seize Euroclear assets globally to recover the value of the seized assets. Such a move would throw a monkey wrench into the entire global clearance and settlement system, creating chaos in the settlement of securities and affecting financial markets worldwide.
An example of the stupidity of U.S. officials. Janet Yellen doesn't understand any of this. Her deputy, Wally Adeyemo, doesn't understand it. But the real danger is not that the treasury market collapses the next day. That could happen over time. It's that Russia retaliates, gets a judgment, and freezes the entire Western clearance and settlement system. Now,
you would think that one official would have thought of this, Jim.
I cannot think of an example going back years where the U.S. has been able to think two moves ahead. They're just not that bright. I mean, Blinken, Jake Sullivan, Janet Yellen's a statistics geek from Berkeley. She doesn't understand this.
Now, let's get to the crux of Rickards' argument. The one asset that can save you from economic ruin. Enter gold. Jim Rickards has long been bullish on gold, and he recently forecasted that gold could reach a staggering $27,000 per ounce. But how did he arrive at that number? Rickards explains that his prediction is not a wild guess, but the result of rigorous analysis. He considers the potential necessity for central banks to return to a gold standard if confidence in fiat currencies, particularly the US dollar, collapses. This collapse could be driven by various factors, such as excessive money creation, competition from cryptocurrencies like Bitcoin, extreme levels of dollar debt, a new financial crisis, war, or natural disaster.
If you say, okay, we have to get back to some kind of gold system to restore confidence, what would the price of gold have to be to make that system work? Well, we have a lot of historical precedent. There was a real gold standard solid gold standard from 1870 to 1914, modified gold standard from after World War I, say 1919 through World War II, the Bretton Woods standard from 1944 to 1971. So we do have precedent for this. And in every case, you don't have to have enough gold to back 100% of the money supply. Some of the hard shell gold bugs say you do, but that's not true. Historically, you need between 20 and 40%. So let's just take 40%. Look at the U.S. money supply, and I use M1 because it's broader than Fed-based money. It includes checking accounts. It's kind of like the money from the banks that drives the real economy. So if you take M1 and take 40% of that and say, okay, that's how much gold I need to back it up, and then say, okay, how much gold do I have? The answer is 8,133 tons. That's how much gold the U.S. has. And just do the math. And this is, as I say, this is seventh grade math. You say, what would the price per ounce have to be for 8,000 tons to back up M1? And the answer is $27,000. By the way, I did the same math not that long ago. Well, 7-8 years ago. And the answer was closer to $15,000. But the reason it's higher, gold is still gold, but the money supply is a lot bigger. So with the same amount of gold and a larger money supply, you need a higher price per ounce to back up.
Rickards, who previously forecasted that gold would reach $15,000 per ounce, has now raised his prediction to over $27,000. In his recent column, he wrote, quote, "My latest forecast is that gold may actually exceed $27,000. I don't say that to get attention or to shock people. It's not a guess. It's the result of rigorous analysis." The key to his analysis lies in the historical role of gold as a monetary standard. Rickards concedes that there is currently no appetite for a gold standard among central bankers, as they prefer forms of money they can control. However, he argues that if confidence in fiat currencies collapses, central bankers may return to gold out of necessity to restore order to the global monetary system. In such a scenario, gold would need to be backed by a significant portion of the money supply.
If things kind of remain the way they are and confidence in the dollar remains, we can talk about that, by the way, because there are arrows directed right at the heart of confidence in the dollar, having to do with Russian assets in the war in Ukraine. But if confidence is maintained, then it's a market factor. Maybe you don't get there. But if you have to go back to a gold standard, $27,000 would have to be the price in order to avoid massive deflation.
So what does all this mean for you, the investor? According to Rickards, gold is the ultimate hedge against economic uncertainty. Central banks have already been increasing their gold purchases, and demand remains robust despite rising prices. Rickards believes that we could see $27,000 an ounce gold by 2026 if the current trends continue. This might seem far-fetched, but considering the potential for a collapse in confidence in fiat currencies and the growing interest in gold-backed alternatives, it is a scenario worth considering.